Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE FinWiz powered by CNBC TV 18 Season 3. Today we're at the headquarters in Mumbai, Mumbai of one of India's leading IT global services provider, L&T Infotech.
One of India's leading global IT services company, L&T Infotech is ranked by NASSCOM as the 6th largest software and services exporter from India. The IT giant provides end-to-end IT solutions and services to banking and financial services, insurance, engineering and construction, consumer packaged goods, retail and pharmaceuticals, and many more industries. NSE FinWiz visited L&T Infotech in Mumbai with the country's finest experts to advise and educate the young employees on investments and financial planning.
And we're now joined by our two very special guests. We have CA Harsh Rungta, who's a SEBI-registered investment advisor with harshrungta.com. And we have Feroz Aziz, who's the Deputy CEO, Anand Rathi Financial Services. Welcome, Harsh. Welcome, Feroz. And our core topic for today is mutual funds. So, Harsh, let's start off. Mutual funds. People find that very confusing at times. How is a mutual fund different from stocks or what we call equities?
So I think most people confuse mutual funds with equities, and people assume that mutual funds means investment in equity. Mutual fund is a method of investment. A lot of people, a lot of investors pool their money together, appoint a manager effectively, and that manager invests based on whatever he has promised. Now that investment could be in debt instruments, that investment could be in equities, it could be in gold. Very soon you might have real estate as well, and also a mixture of that. It has to be told to the investors what is going to be the investment pattern. Okay. So the key of investment in mutual funds, so to say, is using the principle of pooling and getting an expert help to invest. I think irrespective of where you want to invest, whether you want to invest in equity, even debt, even gold, anything, mutual funds can be used for investment.
Okay. So, Feroz, there was a time when any ad you heard on television or on the radio about mutual funds did have a disclaimer at the end which used to zip past. Now it's become a little slow, so you can actually hear them say mutual funds are subject to market risk. Please read the offer documents carefully before investing. So, what is this risk? Is it not a good idea to get into mutual funds if I'm risk averse, if I want to take low risk? Or there are options that I can take if I'm a high risk appetite person and I'm a low risk appetite person. Can you tell us a little bit about that?
See, I think risk is a very, very important term. See, nothing ventured, nothing gained. Risk to a common man is a very negative term, but it's actually the most positive term. Why? Because if everybody has different quantums of wealth, what distinguished is their risk-taking capability. So risk, if you take it in your stride and use it to your advantage. Now coming to the specific question of what are the risks in a mutual fund, people generally, when they think of risk, one risk which they think of is that I give money to somebody and he goes belly up and he doesn't return my money. That risk, which is the very large risk where you get all your money back or you get no money back, that risk doesn't exist with mutual funds because it is the most structured format, transparent format that I give him money, he can't run away with my money. Okay, unlike some non-structured kind of lending and borrowing, right? So that's one big risk which is not there in a mutual fund because it's a trust which gets formed, which is a legal entity, which all the people who own small portions of the mutual funds are beneficiaries. So that primary risk which people generally associate is not there. One other risk which exists is the price risk. See, the price of a mutual fund can go up and down, right? Which I think is a very small risk because price can go up and down, but over a period it will eventually go up. Why? Because there's a very smart professional managing it. right? So that risk is what that disclaimer speaks about. And to my mind, that's a significantly small risk, because there are some risks in the world which correct themselves automatically. Like if you have a wound on your hand, it corrects itself automatically, right? But if you have cancer, it doesn't correct itself, right? Because there is no fighting mechanism in the body. So lending to somebody and running away with the money, you give him 10 years, he's not going to come back and repay it to you. But a price risk is the risk, and that's a very small risk relative to what is the risk perceived.
Lauren says that when you say, stay invested for the long term, what is the ideal time one should stay invested? So what is long term when you say long term?
Okay, yeah, I think that's a lovely question, Lauren, because there are two ways you can define long term. Mark Twain has said that in the long term, all of us are dead. So obviously, we're not defining that much of a long term. And when we do these shows on television, you have investor questions who says, I'm a long-term investor. Then you ask him, okay, what do you mean by long-term? He says, 6 months. Okay, so obviously 6 months isn't long-term. If you look at equity, right, which is where I think this is very relevant. And if you look at the past data, see, if you look at the data on Nifty, right, if you look at the returns, I think over 8 years, if you have invested money in the Nifty at any time post 1992, over 8 years, okay, you would never have got a negative return. You can pick a date after 1992, and if 8 years later you look at what the Nifty was, there wouldn't be a negative return, right? And to lot of investors, not having a negative return is extremely important, right? So I would not say that that is the most important thing, but I think long term by this definition cannot be less than 8 to 10 years. So I would define it based on past data. Anything 8 to 10 years is long term, anything 5 years to 8-9 years is medium term, anything less than 5 years is actually short term. I think that really is a key thing for people to internalize.
Great, thanks. Next question is by Kinjal Uday Shah. Kinjal? Right. Firoz, she says that what portion of the portfolio should be invested in mutual funds?
If you look at mutual funds, currently address 3 asset classes, like when Harsh mentioned: equity, debt, and gold specifically. So mutual funds is nothing but professional management. To my mind, a person can use mutual funds to get to most of the other assets except real estate. So if you have 30% in real estate as an investment, not the house you're staying in, that's not considered a part of your investment because that's a consumption objective. So if that's taken care, and if there is no other real estate, 100% can be addressed by a mutual fund, because there are close to 1,000 plus schemes to cater to all people or all monies of everybody. So 100% can be in mutual fund apart from real estate investment, which you have.
You're watching NSE FinWiz, powered by CNBC TV 18 Season 3. It's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz, powered by CNBC TV 18, and today we're at the office of L&T Infotech.
About 7 years back, we had a great financial crash in the United States, which was mainly because of derivatives trading and a lot of traders, misusing the rules, so to speak. How likely is that to happen with mutual funds? We know that there are regulatory authorities, but despite having regulatory authorities, there were some discrepancies and we had this big crash.
Like you rightly said, Subodh, that last time in 2008, there was a lot of derivative. Now the question is, what is a derivative? It's a little complex instrument which actually helps people speculate or also has other purposes which are safety and stuff. But if people use derivative for speculation, then you can actually bet very big. That's what some large financial institution did, and that's where there was a lot of financial crisis. Coming to how is that different than a mutual fund, that derivative positions in the US were predominantly speculative positions of the financial institutions, not somebody else's money. In a mutual fund, you're managing a third party's money. If I am a professional, for example, managing somebody else's money, and then there is a regulation on me that I'm supposed to do it only with use derivatives only for example, in Indian context, you can only use derivatives for hedging purposes. You can't use it for speculative purposes. You can't, there are so many do's and don'ts with respect to regulation specifically on derivatives on mutual funds. You can buy derivatives, you can buy options, but can't sell options. Okay, so the point here is, there they were taking speculative positions on their own money, especially on their proprietary money. Here there is somebody who's managing monies of somebody else with some regulator overseeing their process, and also in the ground rules it's very clearly laid out, and that gets checked and reported, if not higher frequency, at least on a monthly basis. So that risk of getting that done in a mutual fund is a very, very low risk.
My question is, how does this mutual fund utilities and common account number works?
It is one of the ways in which you can invest. So MF Utilities is a platform which has been promoted by all the mutual fund companies together. Okay. The idea is that once you get what is called a common account number from the MF utility, right? You will be able to invest across any schemes at the click of a button online. It helps you take you online, it helps you redeem online. You can change, suppose your bank accounts change. If you change that at one place, automatically it will get linked to all your existing investments as well as new investments. It's a way of making your investments convenient, faster, lower cost. I think those are the three things. So that is one platform. There are other platforms which offer similar facilities. So I mean, it's one of the platforms that have sprung up recently to help investors do their investments cheaply and conveniently and at a lower cost.
On that note, it's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz powered by CNBC TV 18, and I have two very special guests, Harsh Rungta and Firoz Aziz. Harsh, I want to talk to you about gold. People are still curious about gold. Is it a good option? E-gold, not e-gold? How? I mean, basically, yes. Is it a good idea to buy gold now, or has it reached its peak and it's not going to go up much now? What's your view on that?
I think before I answer that, I think it's what is in order is what is gold. And I think there are a lot of, although at the risk of sounding sexist, there are a lot of women in the audience. Investing in jewelry is not gold. Okay? Because when you take the jewelry out of the showroom, 30% is gone. You take it out of the showroom, maybe 20 is gone, depending on where you buy it from. So that is not clearly gold. So if at all we are talking comparison, when you say you are investing in gold, physical gold would be say a coin or a bar, that is gold, versus buying it electronically, investing in an ETF for a gold fund, or buying some other versions of gold. I think as far as gold is concerned, we have these two schemes on the anvil, or as far as for fresh investment, it is really going to be the gold bond scheme.
Right.
And I think from the looks of it, more details are clearly awaited. but I think from the looks of it, the gold bond scheme clearly is going to be fairly attractive. I think the fear that I have is that it will be too attractive.
My question is, considering that gold has given negative returns in last 2 years, and due to China crisis, it's expected that future will also be uncertain. So do you still suggest to invest in gold ETFs? If yes, then what should be a percentage?
So I think any asset class, there needs to be a balance. You cannot look at what has happened over the last 2 years and 3 years and keep shifting your investment strategy. I think you need to plan your overall investment strategy. And I think when you plan your overall investment strategy, gold will always have a part. Okay? As long as it has a part that is commensurate with your needs. So typically, I think for any client, we would say 5% to 15% of your portfolio should be in gold. That's one. Second, it should not be built one time. You should not just pay money and take that ETF at one time. Like equity, because gold prices are volatile. Like equity, we recommend that you should buy systematically over a period of time. Similarly, gold should be bought systematically over a period of time. So you don't really need to worry about the China crisis or whatever. I mean, the idea is that when you invest systematically, you insulate yourself from a lot of noise as long as you're doing it over a period of time.
Yeah, my question is that is how to build a mutual fund portfolio. That is how much I should invest in balanced, how much I should invest in equity, mutual funds, fixed income.
Yeah. See, that's practically the last step of your financial planning. It is not the first step. First, you need to see what are the goals I have, which I want these financial instruments to meet. That is the first step. There are two types of goals, one which you have to meet. There are some goals which you can do without meeting in a lifetime. Doing a world tour might not be the most necessary thing, but getting your child educated, getting him married if required, getting your retirement corpus in place, all those are need to have kind of goals. So first, laying down your goals is the first step before you get to mutual funds. After you do that, factor in for price rise, which is also called inflation, because money value depreciates significantly. So the next step is inflation. To put things in perspective, 30 years back, whatever 100 rupees you had is just worth 6 rupees today. So 95% of the value of the 100 rupee note has now become 6 rupees. So first step is goals. Second step is factor in price rise. Third step is choosing the right instrument or the pathway which will help you beat your goal. When you finish these two successfully and deliberated and introspected significantly on these, and there's huge attention to be given on those, once you have a freeze on that, then you move to the third logical step of creating a portfolio to do what is the most important question. If that is answered, now coming to, for example, if you have goals which are long term, your portfolio should ideally be skewed towards equity, because equity is one of the two asset classes which over long periods of time can beat price rise and do better than inflation. Okay, so then you at least should have 70 to 80% of your money in equity, okay, if those are long-term goals, and about 20% in debt instruments and some degree of gold if you have a allocation which needs to be given. So in the mutual fund category, you need to have gold, debt, and equity all in the mutual fund basket, out of which you can actually buy golds also as a gold fund.
Thank you so much, Harsh, for being here. Thank you, Feroz, for being here. Thank you so much for having us here.
This basically in the mutual fund section where of course my knowledge was very limited. The basic factors of evaluation is something that I've learned from here. And one important thing which I'm going to take away from here is investing in my retirement plan.
The show was wonderful. We got good answers. They covered all the possible topics, and yeah, it was really useful tips from the experts. And I like the way they got a 360-degree view of the mutual fund industry.
Before attending the show, I myself did not know much about mutual funds at all. And now, just 2 minutes back, I was guiding someone who couldn't attend the show. about mutual funds. So fantastic. The answers are very crisp, which are seldomly found. Like, the answers to the queries, very crisp, too good.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But before we go, here's a chance for you to tell us how much you've learned on the episode.
A person who's interested in stable and diversified investments can grow his or her savings by investing in which asset class? Shares, gold, mutual funds, all of the above. Send in your answers on fwq@network18online.com.
So be sure to send in your answers to the viewer question. Until next week, from the entire team, many thanks for watching.
Focus. Ideate. Innovate. Enable.